A specific market action just happened, and here is the mainstream response. Silver moved. Commentators immediately started arguing about whether this confirms the bull case or kills it, and everybody went straight back to staring at the price chart like that one number explains everything. And that is exactly backwards. Because if you are trying to understand whether silver is actually tightening, repricing, or setting up for something bigger, the silver price is often the last thing you should be looking at, not the first. And I think you deserve the full story, so here it is. I am recording this right now from Phoenix, and I want the timeline to be crystal clear because this is one of those topics where people realize they were watching the wrong thing only after the move has already happened. So comment what day and date you are watching from, because I always like seeing when people caught the framework versus when the market finally respected it. And real quick, if you value this kind of grounded, no hype precious metals analysis, do me a favor, subscribe and comment FinTalk OG so the algorithm knows you want more of this. Now, in case you have not seen what I am talking about, here is the lazy narrative. Silver is up, silver is down, silver is stuck. Therefore, the market is telling you everything you need to know. On the surface, that sounds reasonable because price feels like truth. But when you slow it down piece by piece, you realize that is not the whole story. Not even close. Because the first place these stories usually get weak is when people confuse the quoted price with the underlying state of the market. A quoted price is a surface signal. It is not a full diagnosis. Same asset, very different interpretation depending on what is happening underneath. So I am going to break down three things. First, the three numbers I think matter more than the silver price if you want to understand whether a real tightening or repricing process is underway. Second, why those numbers usually move before the headline price does. And third, what you should actually do with that information if you are a stacker, a trader, or somebody building longer-term hard asset exposure. You are going to walk away calmer, sharper, and more in control of what you own. So let us start with the first number, and that is lease rates. Here is the clean way to think about it. If silver is easy to find, easy to borrow, and floating around comfortably in the market, lease rates tend to stay tame. If silver becomes harder to source physically, the cost of borrowing real metal starts rising. That is not some theoretical spreadsheet detail. That is a signal. It tells you the physical side of the market is feeling stress even if the paper price has not fully reacted yet. Let me be blunt. A lot of people stare at spot and completely miss the fact that the borrow cost is where the discomfort shows up first. Now here is the skeptical alternative. Could lease rates spike temporarily for technical reasons that do not mean a major shortage is building? Sure, that is possible. Quarter-end balance sheet pressure, short-term logistics issues, regional bottlenecks, those things happen. I am going to say something that might annoy both sides. Not every lease rate move is a silver moonshot signal. That is plausible here is how it can fail. If you see lease rates rising alongside stable exchange inventories and no sign of stress in minor commentary, you may just be looking at temporary friction. But if lease rates rise while other physical signals also tighten, that is when the story gets real. Now, the second number that matters is registered inventory, not total inventory. Registered inventory. Stay with me on this because it matters. This is where regular investors get badly confused by warehouse reports. Silver can exist inside the system without being readily deliverable. Eligible is one category. Registered is another. Here is the clean way to think about it. A lot of people hear inventory and imagine one big pile of available metal. That is not how it works. Think about airport tickets and seats. A lot of tickets may have been sold into the system, But not every seat is equally available to be assigned the moment pressure hits. Registered silver is the metal standing closer to actual delivery function. When that number starts thinning while open exposure remains large, the market gets more fragile. Here is what nobody wants to say clearly. A strong-looking total inventory number can create a false sense of comfort if the registered portion is being drawn down. That is the kind of statistic people use to say, relax, there is plenty of metal, while the part that matters for immediate pressure is getting leaner. A correlation is not a contract, but when registered metal drops hard enough, paper confidence and physical confidence start to separate. Now here is the skeptical counterpoint. Could registered inventory decline and still not lead to a major price event? Absolutely. Metal can be reclassified, holders can respond. The system can absorb stress for longer than people expect. That is plausible here is how it can fail. What the skeptics miss is not that the system can adapt. It is that the adaptation process itself is information. When the market has to keep shifting metal around to preserve comfort, that tells you comfort was not natural to begin with. The third number I want you watching is minor margin. Not just the silver price, minor margin. Specifically the spread between realized selling price and the all-in cost of getting silver out of the ground and processed. Here is why that matters. If silver is trading at a level that looks fine on a screen, but miners are getting squeezed by rising energy, labor, regulatory, and capital costs, the supply response gets weaker over time, even if the paper price looks stable. This is the gas pedal and speedometer problem all over again. The speedometer is the price. The gas pedal is the margin. If margin gets weaker, the system is not accelerating the way the price alone makes it seem. Here is a question for you. If you had to choose just one signal to watch before silver makes its next major move, would you choose lease rates, registered inventory, or minor margins? Drop that in the comments because I read them, and the answer says a lot about whether people think in price terms or structure terms. Now let us talk about why these numbers often matter more than spot itself. Spot is loud, structural signals are quiet, and markets love to let the quiet truth sit underneath a noisy surface until enough pressure builds. Silver is the awkward cousin of gold that shows up to the family event, does something wild, and then disappears for a while. It does not glide, it lunges. It takes the stairs up, then tries to jump out the window. That means if you only watch the lunge and ignore the pressure build, you are always late. If you want to understand whether a scenario is building, you do not just watch the headline metric, you watch lease rates, registered inventory, and minor margins together. Now here is a simple action plan. No drama. Step 1. Build yourself a one-page silver watch list that includes those three numbers and update it on a regular schedule. Not every hour, not emotionally, just consistently. Step 2. Define your purpose. If you are a stacker, your job is to accumulate sanely before the market gets loud. If you are a trader, your job is to connect those structural signals to actual levels and invalidation points. If you are long-term, your job is to recognize that structure usually improves before price recognition catches up. Step 3. Do not make the common mistake of treating a dead-looking chart as proof that nothing is happening underneath. Sometimes a quiet chart is exactly what structural tightening looks like before the crowd notices. Step 4. Keep it sane. Silver does not need leverage to be exciting. It will provide the excitement for free. Now let us map two plausible paths without pretending we can predict the exact candle. Path 1 is the structural tightness path. Lease rates continue to firm, registered inventories keep thinning, Minor margins stay under pressure, and silver eventually responds with the kind of move people only understand in hindsight. I am not predicting it, I am saying it is within the set of things this market is capable of doing. Path 2 is the false alarm path. One or two signals flash, the market adjusts, inventories stabilize, and the visible price continues to frustrate people longer than they expected. Both worlds can be true at different times. That is not a crash call. That is a maturity call. Now here is the uncomfortable truth. A lot of people do not actually want to understand silver deeply. They want a cleaner chart, a louder headline, and emotional permission to buy after the move starts. Institutions and patient operators use the quiet phase. Retail usually wants the dramatic phase. That is why watching the wrong number keeps people late. Here are the 4 rules. 1. Decide your maximum allocation first. Write it down. If you are losing sleep, you are too big. 2. When something runs hard and you are up a lot, take some off. Not all. Some. If your position doubles, consider trimming half. Lock in the original bet. Let the rest run. 3. Do not use leverage on silver. 4. The best time to buy is not always when you are most excited. The best time to buy is when you can still breathe. So here is what we covered. The silver price is not useless, but it is often the last thing to tell you the full story. Lease rates show borrowing stress. Registered inventory shows delivery fragility. Minor margins show whether supply can realistically respond. Those are the 3 numbers that tell you more than spot alone. Stay alert. Stay thoughtful. Do not let a flat-looking chart fool you into thinking nothing important is happening. Now here are my questions for you. Which of the 3 numbers do you think matters most right now? And do you think silver's next big move will come after the crowd notices or before? Drop your answer below and remember to include what day and date you are watching from. If you got value out of this, subscribe and comment FinTalk OG so I know you want to follow up when one or more of these signals really starts moving. And if this helped, share it with someone who keeps staring at the silver chart without ever asking what is happening underneath it. Stay sharp, and I will talk to you soon. And just so we are crystal clear, this is educational content. It is my take based on publicly discussed information and my own reasoning, and it is not personal financial advice. I am not your advisor. I do not know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation. And if you need personal advice, get it from a qualified professional who knows your situation.